Welcome everybody to the Tuesday edition of the Not Your Average Investor Show. Today, we are going over the Q3 2021 market recap that was given to the investors only call yesterday. But because you're part of the Not Your Average Investor Show family, you get the same information today. Welcome everybody to the Tuesday edition of the Not Your Average Investor Show. Today, we are going over the Q3 2021 market recap that was given to the investors only call yesterday. But because you're part of the Not Your Average Investor Show family, you get the same information today. You ready for this, Greg? Because we are officially live on Facebook today. It is Tuesday. We got the Not Your Average Investor Show Tuesday edition Q3 JWB market update. It is always a fan favorite. I am your host, Pablo Gonzalez. With me, as always, the man that they call GC because he's got the genius concepts, because he generates cash flows, because he's a great co-host, and because his name is Gregg Cohen. Say hello, Greg.
Hey, everybody. Great to be with you.
Great to be with you too today. Great to be with the JWB family. As you know, if you are looking to own rental income properties, you are in the right place. If you are looking to find out about the best types of property management for investors, especially if you want to be in Jacksonville, you're in the right place. And if you're a real estate professional looking for an edge in the Jacksonville marketplace and a couple of maybe advantages you may be able to offer for yourself and your clientele, you're in the right place. Next place to go is chatwithjwb.com. Hop on with the team. They will reverse engineer a solution precisely for you. And right now it is time for the roll call. It is light today, but we got some of our family in the house. Let us know where you're calling in from. We got Jennifer fills in from beautiful Monterey, California. We got Leo. Good morning from California as well. West Coast is in the house today. We got Lee Bishop. He's back. Good afternoon, gentlemen. Good afternoon, Lee. Good to have you, buddy. Good to have all of our friends here in the house. As you all know, we want you contributing to the show. There's two ways to do it. One is in the chat, which everybody here is well adept to, but they've kind of changed something in the chat lately. Now you got to change to everyone above where you chat. And that's how you get to talk to everybody else. If not, you're only talking to me and GC over here. Like Leo, you're only talking to us. It only hosts and panelists who likes Pablo's Blazer game today. You know, Greg, usually I wear the Blazer because I'm trying to hide my tiny shoulders. But today I'm just doing it for warmth. I'm just really cold in here and getting it going. GC, what'd you think of the client only call yesterday, man? I thought it was an interesting market update.
Excuse me. Yeah. I really enjoyed the client only call yesterday. I just think we've been doing these client only calls, I believe, for about a year now, maybe a year and a half, somewhere around there. And every quarter we give an update. Every quarter, it's either the turnkey clients or the private lenders where we focus the update. And it has become a really wonderful just connection point with all of our clients. There is a feel that we have when we have 50 or 60 clients that join us, and the trust that they put in us. I think it comes through in this online forum. I feel it, and I'm so thankful for it. And be able to say thank you to them for trusting us for 15 plus years now is really special. And then the questions that we get, I mean, these are really savvy investors, and they want to know what's going on today, and they want to know what's going on in the coming quarters and in the future in terms of real estate. And they want to know what's going on with JWB. So I just really relish those moments that we get to share with clients. And, and here in the group, in the show, we get to do it as well. We get to do it a little bit more often. And of course, there are many clients that are joining us on the show as well. So, I'm thankful for this platform, and the client only call is a really special addition to it.
I like it too, man. I like being a part of it. Without further ado, right? So we got the Not Your Average Investor Show family in the house. A lot of them are clients. Some of them are people that are just looking to get educated on rental property investing. On this update for the clients, we went over some property management statistics, some Jacksonville market pricing statistics, and then some key takeaways. A couple of things we've touched on in the past here on the show, but we just put it into like a real concise form. If I'm somebody that isn't a client yet, and I am just kind of poking around, I'm just interested in this, why do I care so much about the property management statistics that you and I are about to get into?
Well, You cannot be a great turnkey investor unless you have excellent property management in place. If you think that this whole thing comes down to your ability to buy the property right, you're getting day one correct, but you're not getting day 10 or 20 years of owning this property correct, because that comes down to the property management relationship. That is what turns that fancy looking spreadsheet that had all those numbers in it when you made the decision to buy into real risk adjusted returns on investment. And the reality is, depending on who you choose for your property management team, that's going to decide how successful you are, especially if you want this to become a significant part of your overall financial portfolio. The way you win in rental property investing is buying and holding for a full market cycle. That's how you capitalize on all 5 profit centers. Well, full market cycle is 10 to 20 years. That's a long time. You need effective property management in place. So when we're going over the property management stats, as we'll do here in just a couple of minutes, this is how you hold that property management teammate accountable, or better yet, how are they holding themselves accountable to these key performance indicators? That's the mindset that I have when I put this together for you all. And when I put it together for our client only call, is I want you to see on the inside, what metrics are we looking at to make sure that our engine continues to perform? And how do you know that it's going to continue to grow? Because you want to be involved with a successful business who is solving problems, making clients happy today, and you want to make sure that it's going to be here tomorrow. So these KPIs, they matter, and that's why we put them together.
And spoiler alert, KPIs have been growing. You wanna get into them, GC?
Let's roll, man.
Yeah. So tell us about what are the stats that you track most on KPI for property management?
Well, we'll start first with the metric that I think matters most, right? The job of your property management company, bar none, is they have to be wonderful at rent collection, right? You're probably coming to this asset class because you want consistency in cash flows and return on investment. And that starts with rent collection. So we'll start there. And if we give a little bit of perspective, last year in the COVID year, in the first year with COVID, when everything was up in the air, when COVID broke, people didn't know how rental properties were going to perform. People were scared about how we would be able to collect rent in a COVID environment. Quite frankly, when COVID broke, I was scared. Everybody was scared. Nobody had a rule book for this or a game plan for this. But what we shared on the show very early on, if you go back to the episodes from March of 2020, the mentality was that the reasons that you came to this asset class, as far as it being a hard asset and it performing consistently, much more consistently than other asset classes, that should continue to happen with this asset class. Well, while we didn't know what exactly rent collection numbers would be, the theory that, and what my viewpoint was that this asset class was going to perform better and more consistent than other asset classes. And so if we go to 2020 and we look at rent collection through all of the crazy challenges that we experienced as a country and more directly here as a property management company, we collected 98% of rents in the year 2020. That was a wonderful accomplishment for JWB, something I'm super proud of, because at a time where our clients needed us the most, at a time where fear was at an all-time high for the 15 plus years that I've been running this business, our property management team delivered. 98% rent collection in a time of COVID helps people sleep better at night, helps people continue to focus on the things that matter to them, not worried about their rental properties. And at a time like that in COVID, that was really important. So that's where we were. 2021, the thesis still plays, right? Through 2 quarters in 2021, we are at 98% of rents collected. Same old, baby. Consistency. That's why you come to this asset class, and that's what JWB Property Management is here to do for you.
There you go. So that's consistency as far as collecting the rent, but there seems to be an increase here. I think this 4,000 properties, right? We're showing on the screen for a friend that's listening on the podcast here in the future. We are showing a jump in 2020 from properties under management to 3,700 to over 4,000. I think this is the first time that you have under 4,000 under management, Gregg.
It is. It's something that we're quite proud of, to be over 4,000 properties under management. Internally in our team 3-4 years ago, we set the direction that we were opening up our property management services to those who did not actually buy the property from us. So beyond just our turnkey clients, we are managing properties for those individuals who already have the property. They already bought it, or they lived in it, or whatever it is. And we can do those property management services. And the goal that we set for our team is that we're going to be at 5,000 properties under management. And to see that we are making those steps, taking those steps, and that we're now well on our way. To put it in perspective, we were at about 1,500 or 2,000 properties under management a few years ago when we opened up the doors to be able to take on outside property management clients. And so now we're at 4,000 on the way to 5,000. So a really big accomplishment. And the team has just, there's a lot of systems that have to be rethought when you go from managing 1,500 properties to managing 4,000 properties. And there's a lot of investments that have had to be made. We invested in Salesforce about 2 years ago, and it's been a wonderful investment, but it's been a really challenging thing to move all of your systems and the 37 different systems that you had before this into one platform. These are the things that you guys don't see. And the unsung heroes really are the teammates that have allowed for this growth. The property management team specifically has just done a wonderful job and makes these numbers that I'm going to share with you really incredible and really easy on me being able to be here and just be the voice for them.
Awesome, man. Awesome. So that is overall look at the portfolio, properties under management, total rent collection. What about how are you doing as far as renting new houses and duration of leases?
Yeah, so now we've kind of seen the overall picture of JWB property management. The most important metric for you is rent collection, and then you want to be established with a company that continues to have others independently make the decision to have us manage their property. That's what you see with those two numbers. Now we're going to segue into the front end of the property management business, which is our ability to rent to new residents coming on board, right? If we look at 2020, we set a new world record for JWB. We rented over 1,100 homes in 1 year. When we started this company in our condo 15 years ago, I never thought that we would sit down and look here. I never thought I'd be doing a show with my friend Pablo here and with all of you. And I definitely didn't think that we were going to be able to accomplish over 1,000 houses rented in a year. It's truly a really wonderful accomplishment for our leasing team and our team overall. And then as we look to 2021, through 2 quarters in 2021, we are on pace to blow that metric out of the water. We're actually on pace to beat it by 17%. I did the numbers on it. We have 672 rented houses through 2 quarters in 2021, puts us on pace for over 1,300 homes rented this year. Will be another new world record for JWB.
Amazing. So what are you attributing that to, Gregg? Is that's kind of like the whole market going crazy, or why such a big jump, and why back-to-back record-breaking years?
Well, I think it's a combination of a number of things. Let's talk about the market, right? The market's working in our favor right now. Overall, there's a limited supply of housing. And when you have inventory in a limited supply area, right, in a sector that has a limited supply, you are in a position of strength. So I think every one of our clients, all of those who are watching this show, who are thinking about becoming clients, if you own the assets right now and you're trying to rent them out, you're in a position of strength. And this is something that we have talked about for a while now because of the lack of building that happened from the Great Recession. Those who own assets in that environment, when there's not a lot of supply around, you're going to benefit from all 5 profit centers. So there is certainly something to be said for that. But there are other property management companies that are decreasing their number of houses rented, even though there are positives that are happening in the marketplace, or that can't achieve top dollar rents, or that it's taking longer than it should to rent out houses. So if we just only looked at the market component, we would be doing a disservice. There has been a tremendous amount of change that successful property management companies have dealt with and have learned how to thrive in this COVID world. And a lot of that credit needs to go to the team that we have, the talent that we have on our team of real estate agents who lease our homes is top notch. And, it's nice to say that the market is generating this, but that's just not the truth, right? It's those individuals that get to work and build a relationship day one with residents that are signing long-term leases, right? These numbers that I'm showing to you could be so much better if we just went and did what every other property management company would do, which is just sign a 1-year lease. Our team continues to hold the standard of signing 2 and 3-year leases because for you as a rental property investor, that's how you win long-term. So that component, the talent that we have on the team is absolutely driving this. There's certainly something to be said as well for the systems and the resources that our entire company has put into play here. Like, for example, we went to self-assisted showings even before COVID broke. At the end of 2019, we went to self-assisted showings for everybody who was renting houses. It was one of the most timely changes of systems that we have ever done here at JWB, because of course we know what happened when COVID broke in February and March of the next year. But that's an incredible example of other teammates at JWB who are also unsung heroes, right? Our accounting team, for example, you haven't heard me talk a lot about our accounting team. I think if you're a member of an accounting team, you're just this amazing individual because you do so many great things and you don't expect to get the credit. But our accounting team has been heading up our Salesforce transition and then making that transition smooth on every other part of the company. And so those resources, those decisions, the systems that have changed to support this type of growth is the third component of why we're doing it.
Yeah. And if you mentioned something, right? You mentioned the idea that you could be driving these numbers up even more if you were going for 1-year leases. And Scott Belote notices here in the chat, he puts, I love seeing the average duration ticking up versus last year of duration of initial lease, right? So as you were pushing this, we also seeing on the screen this increase from average duration of an initial lease from 26.4 months to an average duration of initial lease to 26.5 months, right? So moving in the right direction of long-term. That is, if you're doing the math at home, that's 2 years plus, like a quarter, right? Mm-hmm. And continuing to drive it. You want to talk a little bit about the importance of that?
Yeah, it's the biggest differentiator between property management companies. If you're thinking about doing a business with a property management company, ask them how many years they sign their initial leases for. You're going to get 1 year from most property management companies. That never makes sense to me, because if you're going to win in rental property investing, you need to have residents that you treat like gold and they stay in those homes for a very long time, 3 years, 4 years, maybe even 5 years, right? Well, that all starts with signing long-term leases up front. And other property management companies don't do it because they're not incentivized to do it. They would make less money if they did it, and they'd have to work twice as hard, 3 times as hard. And that's why most property management companies don't do it. But we do. We think it is critical to our strategic plan for your success. And so it's hard to move that number up. But when we see it tick up from 26.4 to 26.5, that's great. That's fantastic for us. We want to continue to move that number up slowly but surely.
Yeah, love it. So, Drew Barnhill here corrected me in the chat, 2 years and 2.5 months. You're right, Drew. I was just shy of 2 years and a quarter, but you were correct. Thank you for
keep him accountable over there, Drew. I like it.
Yeah, please do, because I will start to believe all my own stuff. All right. So other KPIs, Gregg, I know that number of re-signs is important, average duration of resident stay. We can talk evictions. You want to run us through some of those numbers?
Yeah, absolutely. So re-signs are so important. It is something that a lot of rental property investors don't focus on, and certainly property management companies don't focus on. But think about this. Every time your property manager re-signs a lease for you, that is saving you $5,000 to $6,000 of real cost that you don't have to spend. It is one of the biggest things a property management company can do for you to increase your bottom line. And it's something that we think of internally here at JWB as another sales opportunity. Our property management team thinks about this as a sales opportunity because we know how critical it is for you, and you just don't see that elsewhere. So in 2020, we re-signed 887 leases. Again, that was a world record. That's 887 residents independently making the decision to renew their lease with JWB for somewhere between 1 to 3 years. And this is after them signing the first lease, which was either a 2 or a 3 year lease. So that is a hard standard to achieve, but we did it 887 times in 2020. In 2021, you guys see the theme right now. the theme is that there's continued growth in all major metrics here for JWB Property Management. We've re-signed 581 leases through Q2. It's actually more than that if I went out through, August 10th here. So we are on pace to have over 1,100 lease re-signs in 2021, an incredible amount of wealth generation for our clients.
Awesome. Awesome. And it seems like the average duration. So we have those numbers on the screen right now. Average duration of resident stay seems to be even, right? But it'll probably, I'm guessing that this is a number of leases re-signed is a leading indicator, right? So while like average duration of stay is a lagging indicator. So as you are getting more and more people re-signed in the front, that length of stay is probably going to continue to go up, right?
It is, right? It's moving in that direction. All of these good things that we're doing, signing long-term leases, renewing leases, that's going to push that average duration of resident stay number up. But it takes a long time to affect that average duration of resident stay because that number is actually tracked by when people actually move out, right? So you look at how long they stayed on average for the people that moved out. So, I mean, we have residents that have been staying in homes for 5 years, 6 years, 7 years, haven't actually contributed to that resident stay number as well. So we just know if we continue to hit those metrics, right? That's why these KPIs matter. How many homes are we renting? How long is the average duration of that lease? How many are we renewing? If we continue to show growth in those numbers, then average duration of resident stay will get better and better and better. And if we do that, we know that we're delivering more and more value for you as your property management company.
There you go. And Drew Barnhill in the chat with his math degree from Florida State University comes in with 4.5 years. That's 54 months is 4.5 years. Thank you, Drew. I appreciate the math. We're going to talk about evictions and stuff in a bigger picture. But right now, I just kind of want to call out this current occupancy percentage of 97% in 2020, 99% 2021. That 99% seems pretty hard to beat, right? Like what's going on there?
Yeah, it's just, I'm just so happy, so proud to look at this percentage. There's a few metrics I literally check in our business every day. And, sometimes, life, maybe you get thrown something that happens and you're like, oh, it might get you down. I just look at the number of percentage of occupancy and the number of homes that we have on the market. I just go into Salesforce and I just check it out. And it just brings a smile to my face. I mean, we manage over 4,100 homes now, and we have about 30 that are available on the rental market. And we rent about 30 every single week as well, courtesy of our leasing team. And so, when you are in a position where you have 1 week of rental inventory on the market, it's a really good thing for our clients. That means that they're renting very quickly, and we can be in a position of strength to get higher rents for you, which has been a common theme that we've been talking about, especially over the last few shows, right? It's the strength of this leasing ability to be able to do that, to command higher rents. Of course, the market is helping, but this type of occupancy, 99%, and this type of growth in terms of the number of houses we've rented and the number of houses that we've re-signed. I mean, it's a great time to be in property management, specifically in Jacksonville.
Yeah. And as you say that, I'm just gonna kind of recap here. The growth, great time to be a part of property, to be part of rental property investing. Rent collection percentages year over year are consistent. Current properties under management have grown 19%. Total rented houses has grown 17%. Average duration of initial lease has grown 0.4%. And then we got 31% number of leases re-signed up. The consistent average duration of residence stay, consistent on early termination/evictions, and a current occupancy has increased 2%. So growth all the way around. Let me ask you real quick, what's the difference between current properties under management and total rented houses?
So current properties under management is that over 4,000 number that we just referenced. It was actually 4,058 properties at the end of Q2. That's the total number of properties that we manage. That's individual rental property owners saying, hey, JWB, you be my property manager. And then total rented houses is now that we're the property manager, when one comes up for rental, how many have we rented on a brand new lease this year?
There you go. Okay. So that is growth. All right. So we've kind of danced around evictions, right? Evictions and early terminations. They're constant. They're at 4%. There's also an eviction moratorium update. You want to just kind of hit on the eviction numbers, what it means, and then bring us into the moratorium update?
Yeah, absolutely. So, evictions are an interesting thing to track this year. Normally, I would just compare year over year the number of early terminations or evictions that we have and divide it by the average number of homes that are in our portfolio, and I would have an eviction percentage for you. In 2020, we had an eviction moratorium. We still have an eviction moratorium, and we'll talk more about that in a second, but the number of evictions in 2020 is way artificially low. And so the year over year growth really doesn't make sense there. The best way to do it is to look at a world pre-COVID, pre-eviction moratorium, which was 2019, and to see what your early termination or eviction percentage is, and then to see what it is now, and really to see what it will be in 2022. The farther we get away from an eviction moratorium, the numbers will become more and more readily available and make just more sense. So if you look at 2019, our total early termination and eviction percentage is 4%. That's where we have been historically, and that's where we were in 2019. We had 132 total, either early terminations or actual evictions. As we're looking, yes, so there you go, 4% in 2020. As we're looking in 2021, we're right there at that 4% number again. And so I think that, we're right back to normal. And now as we kind of go in, I guess I'll just kind of go into really kind of where we are as far as a eviction moratorium update as well. Any more questions on that, Pablo, and the numbers there, or should I just jump right in?
No, I think we just kind of jump right in. I think this is something we learned from the call yesterday. I think it just kind of goes together, and we're going to get questions on it. So might as well knock out all the eviction stuff right now.
Yeah. So, and we went pretty deep into the eviction moratorium last time on the show. Where we are right now is that we thought the eviction moratorium was going to be over at the end of July, just like we thought it was going to be over 3 months before that, and 3 months before that, and 3 months before that, and 3 months before that. We all were surprised that the Biden administration actually extended the eviction moratorium for different parts of the country. Jacksonville is one of the parts of the country that the eviction moratorium has been extended through October 3rd. What does this mean for all of you out there who own Jacksonville properties? What does this mean for JWB Property Management as we continue to navigate this? Nothing has really changed today versus the way it's been for the last 6 or 9 months. Really, what was a monumental shift was somewhere around 6 to 9 months ago when we were able to actually start the eviction process. That was really, really critical, because what that allowed us to do is to have more weight in our conversations when we're talking to residents who have been affected by COVID, and really try to figure out a long-term win for them. To know that we could actually start the eviction process makes it very real, and it allowed our conversations to hold more weight. And the positive thing is that people don't want to rack up a huge rent bill. People want to figure out a solution. If they have two parties that want to come to a solution, many times you can, especially if you give it time. And there's been a lot of time for us to figure this out, of course. So what's been happening is those residents who have been affected negatively by COVID, many of them we have wonderful communication with, and we've worked out payment plans for those individuals. So the great thing, and this payment plan is called a stipulation agreement. This is actually a court-approved payment plan. Not a lot of property management companies know of this or do it because it takes so much time. But again, for us, we know that there's a long-term win with keeping that resident happy in your home. And of course, we want to do the right thing through a COVID environment. So we have been working really, really hard to work with those individuals who have been affected by COVID, who could not make the typical rent payments, to get them onto a court-approved stipulation agreement. And by doing that, we have income coming in for you, which is really important. We have a plan to keep that resident in the home long-term. And as long as all sides are agreeing to that court-approved stipulation agreement, this can be a wonderful for the resident and for you. Because when a resident completes the stipulation agreement, any additional cost that was incurred, like an eviction fee, that is typically about $500 cost to the owner, well, that's a part of the stipulation agreement. You are made completely whole by the time that the resident gets to the end. So as of right now, the key points here are nothing has changed. As far as what's been going on in the last 6 to 9 months, we have been able to start the eviction process for any resident, whether they've been affected by COVID or not. For those who have been affected by COVID, they sign what's called a CDC attestation form, where they basically swear that they have been affected by COVID negatively. And then those individuals cannot complete the final step of eviction. So you can get right to the proverbial doorstep. You cannot complete it with a writ of possession. Now, overall, for JWB's portfolio, we manage over 4,100 homes. There are 23 individuals, 23 residents that have signed a CDC attestation that are not in a stipulation agreement. And I feel for those owners that are experiencing that. Unfortunately, there's nothing that we can do to complete the eviction like we normally would want to. We hope that the eviction moratorium will be over soon, but overall, it's a relatively low number, a very low number relatively to the overall portfolio. That's why we're still able to get 98% rent collection during COVID. And there are others who have been affected by COVID. I think we have somewhere around 35 folks that have signed a CDT attestation that are on the stipulation agreement. So that's really working as a great solution in this tough time for everyone.
Got it. So I did the math. Drew, you can check me on this one, but 0.5% of renters are in this stipulation, not in stipulation and CDC attestation, while the rest of them, another about like 1% are in this stipulation agreement, right? Like I have one tenant that is on that right now. And what it feels like from my end is the idea that my tenant is doing whatever's possible to make all the rent whole, all the fees whole. And therefore, even though I have displaced like 2 months of rental payments, I know I'm going to get that back. So it's really just like moving money from a couple of months to another couple of months. And intuitively, as a human being, I'm kind of happy that they're able to figure out their financial situation, right? Like I don't have to deal with them. I don't know the residents, but like, I know that when my wife and I talked about it, it was good to know that they're kind of back on track. And, it means that whatever derailed their life is getting back together. Right. So I like the idea that there is an option that isn't just the nuclear option and allows this at least half of the people that would be affected by COVID and would be having to go through this stuff. It allows a triple win, right?
And your feeling is very common to the clients that we serve, and it's wonderful, right? You want the best for the resident, right? There's an emotional component to this that, you want this to be a triple win, like you were talking about. It's got to be a win for the resident. It's got to be a win for you as an owner. It's got to be a win for JWB so we can continue to serve you forever. And that's really wonderful. And that's what we see with the stipulation agreement. When we started to do this many years ago, I didn't know if it was going to be fruitful labor, right? I didn't know if people who had, for whatever reason, had made a decision that they couldn't pay their rent when we extended this option to them through the stipulation agreement, if that would change things and if they could figure out a solution or if we could work together to figure out a solution. And what we have found is that about 50% of stipulation agreements work. People pay about 50% of stipulation agreements back in full, and they're right back in, and they're very thankful that we worked with them to avoid potentially a really negative situation in their life. And so there's that compassion angle, and we don't talk about it a lot when it comes to property management. As a property management industry, there's not a whole lot of compassion that's given to residents. But at the end of the day, if you don't treat your residents like gold, this model doesn't work. And that's one way that we can do that.
I like it. You're getting better at explaining this thing every time, right? This client only call is kind of like a great primer to then show up for the show, and you got it all kind of wrapped up in a bow. So that is the current state of property management. Let's talk about macro numbers, right? I think one of the big questions that's out there right now is this market overheated? Are prices going bananas? Is it a time to sit out maybe? What do you think about that, GC?
Well, I think when you're asking yourself, is this a bubble? Is the market overheated? Is there going to be a crash? That's all touchy-feely emotional stuff, right? Go to the data. That's what I do. And so that's what I'll show you here. In fact, if you want to bring up the graph, I think it's really good to have perspective because I was a part of a bubble. I know what it felt like to buy at the very height of the market. I know what it's like for me to put all of whatever money I had when I was 23 years old, which was not much, and a whole lot more that I borrowed on the line, and to have bought 40 properties at the very height of the market. In fact, your cursor right there is the very height of the market. You timed that perfectly. It's right there in June of 2006. And the market, the median home sales price in Jacksonville was 223,000. Well, when people talk about how do you know that was a bubble? It's a graph like this that helps you see a bubble, right? If you're calling it a bubble, you have to know what the median what the price should have been versus what it is, right? People don't talk about this line of what pricing should be, but actually, if you look at the historical data, this is a number that you can know for your market. We know it for Jacksonville because we've done the research on it. And when you know what the median projected sales price is, it gives you the actual perspective to know if this is a bubble-like tendency or if this is just a market correction and pricing coming back down to normal. As we see that median home projected sales price, that's that red line, that smooth line. The way that is built is you go back 30 years and you look at what the average historical home price appreciation has been in your market. And what has shown to be true is over the next market cycle, history repeats itself or very close. And so a market cycle means that you're going to have roughly the same home price appreciation in your asset class over the next 10 to 20 year cycle. And wouldn't you know, if we go from January of 2001 to June of 2021, that's a 20-year cycle. Guess what? In Jacksonville, home prices appreciated at the rate that this trend line predicted they would. That is what we mean by a real estate cycle. Pretty cool, huh?
Pretty cool, man. So like we've looked at this graph a bunch of times, right? And I think that if you look from here to here, boom, cycle, right? Because it hits exact to exact. And then conversely, there's the idea that if you're looking here, right? Like, so when I said here to here, right, it's January 2001 to, let's call this April 2017, right? So that's that 10 to 20 year window. And then if you were to extrapolate that again, right, if you're looking at June 2006, when it's the top of the market and the way that it's all trending, it seems to be it's gonna hit also within that 10 to 20 year window, because we're now in June 2021. So even if you would have bought at the top of the market, which you have, Greg, right? Like you bought a bunch of those homes, you've made the cash flow, you've made the profit centers of debt pay down, and you've made the tax deductions, cash flow. And at some point here in the next 5 years, you're also going to hit on the appreciation that was predicted, even in worst case scenarios.
Yeah. Markets return to the norm. Yep. If you bought at the height of the market right now, you've experienced less than 4.3% appreciation from June 2006 till June of 2021. It's been about 15 years. You just chose the most crazy data point out there that you possibly could, right? The biggest bubble we hopefully will see, at least for a very long time. And you're still achieving home price appreciation, which, depending on who you bought the property from, you probably didn't bet on any. You still have achieved home price appreciation. If you take this to the biggest extreme by going back to June 2006, and if you give this a full 20 years, we're expecting home prices to go up in the next couple of years, 2-3 years. You're probably going to be really close to 4%. Even then, even when you bought at the very height, the worst data point you could look at to buy, you're still going to probably be very close to it around when you give it that full 20-year cycle. And the one thing that I would point out here is, I wouldn't really just go and look at when you hit that trend line as kind of defining a cycle. A cycle is really defined between 10 to 20 years, because if you go back and look at values in your market over 10 years, 15 years, or 20 years, that's where that range is where you typically see a home price appreciation rate average, which is congruent with the overall long-term historical average. So you could get into a tough spot if you just said, well, listen, I hit a cycle at 7 years, or, you might say a cycle was from 2001 to 2008 because, it technically hit that line. I wouldn't do that. I would stick to 10, 15, 20 years. And when you go in between, sometimes it takes 10 years, sometimes it takes 20 years, sometimes it takes 15 years. You're generally going to see that average appreciation rate over that time match very closely with what you predicted based on historical accurate.
Okay. That makes sense. So bring us home, man. So right now we're here at this red trend line. It looks like we're spiked slightly above it. What's going to happen now? Are we going to go into a bubble, or what's going to happen?
Well, so we're going to look at metrics. Every time I get asked a question about a bubble, I'm going to reference two metrics. I'm going to reference where is our pricing today versus where it should be, right? Where is our pricing today versus what that median projected home sales price says we should be? I'm going to look there. That doesn't tell every bit of the answer. That is not saying that when we go above the line, which we just have gone above the line, that doesn't mean that you're going to have a real estate crash, right? That's a data point that just shows you that over time, we should probably see slightly lower than 4.3% appreciation. That's all that means, right? So I'm going to look at that data point. Now, at the same time, that's that macro outlook. At the same time, I'm sitting here telling you that I've never been more confident that home prices are going to go up over the next year, right? So if we're talking macro, this means that over time, we're going to get back to that norm, right? That 4.3% norm. Mm-hmm. If you're above the line over the next 20 years, you're probably going to see slightly lower than 4.3% or somewhere around there, right? We're kind of splitting hairs here. So that's one data point. The next data point is months of inventory. Months of inventory is going to tell you what's going to happen in the short run. So the graph that we just looked at is what we're talking about over the long run. Months of inventory is going to tell you what's going to happen over the short run. And then we're going to make the best decision, and we're going to help you make the best decision taking that information in, as well as a lot of other data and conversations and knowledge and experience and all that good stuff. But it's going to come down to those two data points. And right now, those two data points are showing us that we expect higher than normal home price appreciation over the next 12 months. And over the long haul, your pricing is right where it should be.
There you go. So a couple more data points. So higher than average home price appreciation, short run, long run, you're right on pace, right? So it seems like upside with limited downside, which is kind of like the beauty of this asset class, if I'm not mistaken.
Yeah, exactly.
And then the other data points that we have for the short run stuff, we just popped this up on the screen. We got June 2020, the median price sold was $255,000. June 2021, median price sold is $300,000. That's the first time it's happening in Jacksonville, right? Median home price above $300,000. Homes at the same time, the homes on the market have almost halved from June 2020 at 7,400 to June 2021 at 4,264. The home sales have gone up from 3,155 to 3,631. Months of inventory has gone down from the stat that you just talked about in the short run, from 2.35 months of inventory to 1.17 months of inventory. And the year over year appreciation from June 2020 of 4.2, which is at the historical average, to June 2021 has gone from 4.2 to 15.7%. So all trends pointing towards this is the beginning of this acceleration cycle that will then at some point taper off into the long term trend. But right now, the going's good short run.
Mm-hmm. You nailed it, man. You know, when you see months of inventory, and all those numbers, of course, are really important. Most people focus on the pricing. What we focus on is months of inventory, because if you nail an understanding of months of inventory, you are going to have a 6 to 12 months heads up as far as what pricing will be. So this is why when COVID broke in March of 2020, for those who were the early veterans of the Not Your Average Investor show, you'll remember me saying, I do not expect home prices to go down. Even though I don't know what the heck is going on in the world right now, I don't see home prices going down. It's because the months of inventory metric was way low. If you're below 6 months of inventory, that's an indicator that you're going to see higher than normal home price appreciation. And I had never seen it at 2.35 months of inventory back in June. And so I didn't know what was going on, but I did the math, and I just didn't think that overall house buying was going to just completely be obliterated. You know, I thought that in order for us to maintain, 2, 3, 4, 5, 6 months of inventory, you needed, I just didn't see all the home sales going away. So it was really easy for me to look at the numbers and predict that home prices were definitely not going to drop. Now, I didn't say that they were going to appreciate by 15%. So I'm not that good.
You're not that good, man. But you were, I mean, that was kind of a watershed moment for us, right? Like we were still pretty new in this whole like having the platform and having a stage. And you're like, man, I don't know. I
I
remember
was
you
scared about
telling me,
saying it.
yeah, you were scared, man. I remember you telling me to go back into the past video and be like, hey man, do you think we should like clip that out? I was like, no, dude, let's just let that thing play and
Yeah.
let's see if you're right or wrong. And we'll use it accordingly. And in a time where everybody didn't know what was going on, you stuck to that statistic. So I just want to say that that's a really good way of putting it. Most people focus on price. We focus on months of inventory because that's what it was, right? Like it was knowing that that's the driving statistic. And we just presented a whole bunch of other statistics that support that. Raja Bantu asks in the chat, he says interest rates were dropping for the last 30 years and are at historically low rates. If the interest rates start to go up, will the historical trends hold?
So he's asking if interest rates continue to go up, will the historical home price appreciation rates hold? Is that the question?
That's it.
Yeah. I mean, your interest rates right now are so at the end of the day, this is about supply and demand. And there's investor activity in a marketplace, and there's also homeowner activity in a marketplace. Supply and demand is largely affected by population growth. That's the demand side. So if you have a place that more people want to come and live in, are they going to do that, right? Jacksonville has that going for it. And then a lot of it is the supply of housing. So what have builders been doing for the last 10 years? Well, in this case, supply hasn't met demand. We stopped building after the Great Recession. And we just now are starting to meet the demand that we could meet or that we have today. So there's like a 10-year lag of undersupply, and you just can't solve that problem overnight. So that's what it comes down to. When you see supply and demand numbers out of whack, meaning that you have less supply and more demand and you hold assets, you're in a good position. And yes, so these long-term metrics, the 4.3% is built in environments where you had really high demand. It's built in environments where you had really high supply. Overall, Jacksonville's population has been one of the fastest growing, especially over the last decade and probably before that, if I looked up the numbers. So those things are really what drive this overall home price appreciation rate. Interest rates, of course, is something that people are sensitive to today, but it doesn't wag the dog when it comes to home price appreciation rates.
Interest rates don't wag the dog when it comes to home price appreciation rates. That's a quote card, Gregg. We're making that one for you.
Actually, let me preface that one. It doesn't wag the dog over a full market cycle, right? If you're telling me like one year to the next and you jumped interest rates like 3%, it might wag it, but context there, talking full market cycle. Let's try to fit that on a quote card.
Yeah, I already figured it out. Don't worry about it. I've been doing this, Gregg. All right, man. So that's pretty good data on where it's coming and where it's, like where it's been, where it's going. Let's talk about JWB inventory. Let's bring it home.
Yeah. So with this client only call and with this real estate update, I want to give you an outlook of what we see inventory doing within JWB really over the next quarter. We have a really good grasp of it because we build our inventory. We know what's in production. And also we know that existing inventory, renovated homes is really, there's just very, very little inventory out there. So what you all should expect, and if you're a JWB client, this is what you will be able to purchase really over the Q3 and getting into Q4. You're going to see a lot of new construction, which has been the theme, especially over the last quarter. You're going to see more of that, a whole lot more of that. And you're going to see townhomes. This is an opportunity that we have from time to time, but I think over the next quarter, you're going to see a healthy amount of townhome opportunities. And townhomes are brand new construction. Again, we build it just the same way we build a single family detached house, but townhomes have a lower purchase price, which is always really nice for those who are investing in rental properties, right? So your low price point for a townhome might be around 180,000, which is great. Your low price point for a single family detached house is somewhere around 200,000. At the end of the day, they both produce the same risk-adjusted return on investment. So there's somewhere between a 6% return to an 8% return for both townhomes and single-family detached houses. So we don't love one more or over another because, again, they produce those risk-adjusted. But you can get in at a lower price point. This might help you diversify and get 3 assets instead of just 2 assets or something along those lines. So certainly pay attention to the townhomes. And if you have questions, you can reach out to your portfolio manager and talk to them, or you can reach out to the team. If you're not a client yet, start those conversations right now, and we might be able to add a townhome to your portfolio.
There you go. Drew Barnhill puts in the chat, townhomes are hot, hot, hot right now. And millennials love them.
There you go.
We got the slide here just kind of summarizing, right? Average purchase prices are now 180 to 275K for investors, with that lower end being those townhomes. And that's a big opportunity there. Estimated ROI, not including appreciation, 6 to 8%. Estimated interest rates are at 4%. Inventory type, mostly new construction. Gregg, you wanna tell us a little bit about what's going on with the interest rate thing, right? Like yeah, please.
Yes. So long-term, we know interest rates are going to go up, but in the short run, we have seen them come down slightly, which is really incredible. To put it in context, we had the interest rate, well, probably maybe June of last year, we officially dropped our interest rates down to 4% on our evaluation. So anytime you were about to buy a property from JWB, you looked at your evaluation and the cash flows and the return on investment was built off of a 4% expected interest rate. And then somewhere around maybe 3 months ago or so, maybe 6 months ago, we saw an uptick. And so we raised the expected interest rate to 4.125% on the evaluations. This drops your cash flows. This drops your return on investment. So we would love for that to continue to go back down. We didn't really think it was going to, but with the lending market right now, we've actually seen it come back down. So you'll see 4% expected interest rates on your evaluations. This is great. This is a nice bump to your cash flows. And I can tell you that it will not be this way years from now. You know, these interest rates are incredibly low. And I've talked about it over and over and over again. The deal is the debt here. The reason why I believe this is the very best time that more wealth creation will be had right now for buying rental properties is because of the debt, because interest rates are so low. And we have the blessing here in this country to actually borrow this debt for 30 years. And you can do it on assets that pay for themselves every single month. The deal is the debt. And right now it's back to being 4%, which is a really great thing for clients.
That's a big deal, man. That's a typical moment that we have here on the show. That's one of those, just like, if you have the ability to make a move now, right? Like that. As you're writing this, I'm like, man, how can I cash out certain things? So I'm doing the calculation on the 20% for the townhomes, right? Because it's just locking in the long-term cash flow that you get from the interest rate where it's at is what we have been talking about for the last year. There was moments where it was really low, then it jumped up a little bit. Now it's come back down slightly a little bit. So you know that's the window in time to make a move if you can. And if you want to do that, chat with jwb.com. That's the next step. And you also talk about how not just interest rates are kind of like in a beneficial position, but the rent increases are in a beneficial position. And you have like an example that we mentioned on the show last week, but maybe we can touch on it again.
Yeah, exactly. So we've been talking about rents going up. Again, this is because at the core of this is about a lack of supply in both the rental market and in the home buying market for retail home buyers. This is a great thing, right? Rental rates are going up, and Jacksonville overall rents have gone up 8% year over year in JWB's numbers, right? We track this internally. 8% year over year rents have gone up. We actually did some even more detailed tracking because we wanted to see, for you as a client who put a property under contract, what rent number were you told versus after the home was built and you close on it and we actually put the resident in place day one, what rent number did you actually achieve? And so that percentage is actually even better than 8%, right? We are all about under promising and over delivering. And I don't know if I've seen a bigger example of under promising and over delivering, because for the last 60 days, for clients who purchased homes, put it under contract, the ones that closed in the last 60 days, our actual rents are 11.6% higher than what those clients were expecting when they put it under contract. That means day one, you get sometimes hundreds of dollars of additional cash flow that you weren't expecting. Sometimes 2 to 3% higher returns on investment than you were expecting. just because the rental market is what it is and because JWB is really good at capitalizing on it and getting higher rents than you were expecting. So that is one of those hidden benefits. Part of this is something that we plan, to be quite honest. We always want to be conservative with our rent numbers, but we have never been 11.6% conservative. I can tell you that. This is just a great time to be in property management.
That's a big number, man. 11.6% over the life of an asset, an extra $100 a month over the life of an asset, starting, right? An extra $100 a month, starting at an extra $100 a month. That doesn't include all the debt pay down that's going to happen and how eventually it's going to be, $900 a month or whatever. Pretty remarkable. Under promise, over deliver. All right, GC. I think we hit all of our points. And give us a final prognosis. What is the GC recommendation of what is happening right now overall?
Well, I will continue to shout this for as long as I believe it, that right now is the very best time to be buying rental properties. And even more, if you're already a JWB client, you have this incredible ability to expand your portfolio, sometimes without even having to bring additional capital to the investment. Especially if you've owned these assets, like many of our clients have owned them for 5 years, 8 years, you're sitting on equity. Then, we didn't necessarily tell you was a part of what you should expect, but guess what? You invested in the right market with the right team and you have equity. You can turn that equity into additional investments. And ultimately what that does is you lock it in at these extremely low interest rates. It diversifies your portfolio. And if you had a 10-year plan or an 8-year plan or a 5-year plan to get to your passive monthly income number, by taking advantage of what I'm just sharing with you right now, you might drop that number of years by 2 or 3 or 4. You might get to that financial freedom that you were planning for in year 10. You might get there in year 6 or year 7, right? At the end of the day, that's what we want to be able to do for our clients. And we can do that. That's what our portfolio management team is here to help you with. If you have questions about how you might be able to expand your portfolio, right? Do it without even having to bring additional capital to the investment. You can do that. Our team can help map it out for you. And now I just absolutely believe in my core is the very best time to be able to take advantage of it.
Love it, man. It is. It's a good time to be part of this show. It's a good time to have listened to you over the last year and a half. I think it's a good time to continue to listen to you. I'm excited to be on the inside of all of this, and I think we hit all our points. I think kind of what we said in the beginning of the show. If you are looking to invest in rental income properties, right? Like it is the time to do it. Go to chatwithjwb.com. If you are acquiring them on your own and what you want is great property management that exhibits these qualities that preserve the long-term investment of the thing, go to chatwithjwb.com to get them managed by JWB, no matter how you acquired them. And if you're a real estate pro that wants to have an edge in one of the hottest markets of the United States right now, you got to be listening to this and put these statistics to work and impress your clientele and go to chatwithjwb.com to find out how you can partner with JWB to do this stuff. So I thought you did a great job, buddy. Really want to thank the community for showing up today. I know we had another misfire with the invite, but we still got 15 people on. So that just shows the beauty of you all coming through and making this part of your routine. And we don't take that for granted. So thank you so much. And GC, I'll give you last words, man.
Yeah, just many thanks to everybody here. You guys make this special. I'm so excited for the numbers that we were able to share with you, for the future outlook. I mean, listen, I've been doing this for 15 years. It hasn't always been this easy to share numbers of this asset class, or it hasn't always been this easy to show 30% growth and key statistics on property management. And it won't always be this easy to tell you that I absolutely believe in my core that this is the best thing for you to be doing to expand your portfolio. But right now it is. So thank you guys for giving us this platform and for allowing us to be a part of your journey here. And super excited for the POT Dubs on Thursday, man. Can't wait.
Join us on Thursday for the JWB Rental Income Property of the Week.
Week.
All right. I'll see you guys on Thursday. Bye.